Devina Mehra is also joining in. Devina, hi, good to have you on board. I reckon it's all smiles given the kind of rally that we've witnessed after a pretty strong momentum that we saw during Diwali. It looks like the Christmas rally is on and here to stay.
Yeah, good morning. And yes, I mean, I have been quite positive on the market, generally speaking, at least on the large cap front for a while now. And as I've spoken before, it is just that there was enough room created with a huge underperformance through a whole decade of 2010 to 20, when instead of compounding 15-16% as we expect the market to do, it just compounded little more than 8.5%. So that room was created. We are still not above the trend line, so probability of a crash still low. The part to be cautious on is the small cap side.
Devina, hi, morning. Devina, you track global macro indicators as well pretty closely. I saw the way dollar index has cracked below the 102 mark. At the same time, if we look at the data which is being thrown up by a research team, that India is the biggest recipient of FII flows this year among all key emerging markets, and this after this community sold India off in a big manner. It appears they are coming back. If this trend of dollar index crack continues, can this flow accelerate into India and emerging markets in your view?
See, first of all, I mean, I don't think the direction of, I mean, the reason why we want to track the FII flows is because we think it determines the direction of the market. But if you actually look at data over years, over months, whatever cut you want to take, the FII flows have very little correlation with the market movement. In fact, none at all. I mean, this is even when the domestic mutual fund and the domestic retail investor community was not that large, when FIIs were the biggest game in town. Even then, it did not have a correlation. I mean, the biggest proof of that is that FII money started to come in around 1994. And obviously, this was a new source of money, billions of dollars coming in. And 1994 to 2003 is the only 9-year period in the Sensex history or the Indian markets history which showed zero displacement. The markets went up and down, but there was no net displacement. There was zero return over 9 years. So this is not something that I track very closely or at all from the market point of view. The only reason why I do look at FII flows is from the balance of payment side, but not really this. So I don't think you should spend a lot of time really speculating on that. As of now, of course, the US has managed what can be called a soft landing, because there has been no recession and broadly inflation is within control. Though, I mean, one segment which hasn't really responded that much is what they call non-housing services. So that because the labor market has remained strong, but I mean, basically, this whole the picture in the US has turned out better than what one could have expected a year and a half ago.
What do you make of the way macro data is coming in US? The Q3 GDP was weaker than estimated. Is it making a case of a rate cut in US by mid-year stronger, and will India follow?
Yes, US, the case is becoming stronger, definitely. And also the last statement from the Fed was more dovish than what I expected it to be, because they said that we do not want to overcorrect, in a sense, to remain tighter than than is needed, and further break on the economy, which is very different from what they've been saying up until now, that inflation remains number one and we'll do what it takes and we want the economy to slow down. So that's it. So while, I mean, I was never in the camp that you will see a rate cut in 2023. If you go back year and a half, there was a lot of expectation that second half of 2023 itself will see rate cuts, and I was never in that camp because inflation takes time to come down. But definitely you will see a rate cut in 2024, exactly when. Mid-year is not a bad estimate, but one will have to see how the data pans out.
Devina, if you were to just, look back at 2023, There's conjecture out in the market that there's frenzy and FOMO, and that's most evident in what's happening within the IPO space. Even if you were to dig out data, 2021 actually had higher number of IPOs and money raised much more thereby than what we've seen so far this year. But do you sense some sort of exuberance there?
Yes, definitely. I mean, in 2021, I remember on your channel, Nikunj asked me that if I put a gun to your head, which IPO will you buy? The so-called new age tech companies. And I said, even gun to my head, I won't buy it. So, I mean, I think too much of mental space also, besides everything else of the investor, gets taken up by these IPOs. That's not the place to be because, IPOs by definition are mostly risky areas. I was looking at some data in the 1990s. There were years when there were 1,100 IPOs and 1,300 IPOs. And today, if you look at the whole listed universe, which trades with some kind of regularity, it is just over 4,000 stocks. So a whole lot of stocks just disappear into the great blue yonder. So if at all you have to look at IPOs, it has to be a basket. But obviously, as a retail investor, there's no way you have any predictability of when you get allotment. So there's no way you will have a basket. There are enough places in the market to make money. So that this is not something that you should spend any time or effort investing in. So, I mean, basically, be cognizant of risk management. So small caps, IPOs, micro caps, the areas where there has been a lot of exuberance of late are exactly the areas where you have to be careful of and strictly limit your exposure.
Would that be the same prognosis for PSUs as well and the fancied ones, the star performers, your defense, railway, across the board power and its ancillaries? And where do you think the rally would last? What will be the strongest of them all and the fittest of them all where the rally would sustain into next year too?
That's not a space we are heavily invested in. At times we have held, defense PSUs and things like that. But again, our whole investing philosophy is to manage risk. And so therefore we are careful participating in any frenzies. And oftentimes many of these things go by newspaper headlines that so much order goes to so and so and so on, so on and so forth. But there are, like in projects, there are always delays. There's always, how much money you actually make out of it, because even if the project happens, almost always there is a cost overrun. So how much is to be taken by the government, how much is to be taken by the company. So there come like a lot of slips between the cup and the lip. So those things you have to be careful on. Again, not that you should not look at that space, but again, don't have overexposure to that space. Be careful. Investing is a loser's game. So first you have to ensure that you don't lose big time, and then the money will come. In terms of course, where we have reasonable PSU exposure has been banks, where we shifted away this year from private sector to PSU banks. So, we are heavily underweight banks overall, which has again proved to be a good thing this year. But within that, we will be skewed a little towards PSU banks than we used to be.
Interesting. Why would you do that, Devina? And that doesn't mean a clear exit from private banks, right?
Well, banking is the highest weight in the index. So if it wasn't the case, I probably wouldn't even look at banking. As someone was telling me that you keep repeating this statement that I am a nervous investor in banks and lenders. And if you look at even the performance of banks, we were heavily underweight also in 2020 and 2021. In 2020, banks was the only sector index in the negative. In 2021, it was up only half as much as the market. 2022, I think about the end of the second quarter is when we went market weight in banks, and that with price action at one point even became overweight. And 2022 in the last 4 years has been the only year in which banks outperformed. So I think index was up 4.5% and Bank Nifty was up 20% plus. So that has been, but again, this year our system started to signal it's not looking good. So we've been cutting back. And this year also, if you look, the bank Nifty last I saw was up about 9-10% as against the Nifty being up 15. And as I told you, Nifty has a lot of weightage to banks. You take out the banks, and non-bank Nifty would have been up much more. NSE 500 up about 20% year to date. So it has been an underperformer. And with banks, basically, it's a leverage sector, obviously. And sitting outside, you can never know where the negative surprises are hiding. And this is a sector that always gives more negative than positive surprises. So in 2022, the cycle for then was benign with the NPA cycle behind them. And as interest rates go up again in the beginning, banking margins go up. So those were some of the positive. Credit growth was good. But now again, there are a lot of cautionary signs. So yes, we are quite underweight banks.
Okay, that's an interesting take. Thanks so much for joining in. Good to have you on board and wishing you all the very best for the festive season ahead, Devina.
Thank you, and wish you the same and the viewers as well. Happy holidays to everyone.